So, today I wanted to talk to you about what your perfect process is. Because to achieve the perfect setup, the method I use isn't necessarily the best one for you, as I believe that understanding the basic principles and their derivatives is just as important as knowing why we make certain decisions, rather than me simply telling you what I do. So I think it's important to know the basics, the wisdom, the reasons, the logic, and why things work the way they do, because this also boosts your confidence when you're trading. So it's one thing to see things 1,000 times on your screen, but to truly understand what's happening and to let the probabilities play out, as opposed to another trader who blindly follows what they're told, but has no background, information, backtesting, data, or personal experience, only blind faith. And now this is already almost close to being a signal service, but that's not what I'm talking about. I'm simply referring to someone telling you what to do day in, day out, what the strategy is. And when a losing period comes along, obviously they won't stick to the plan. And who do you think they'll blame? Of course, the one who led them blindly. So, in my opinion, possessing wisdom is essential. So, if we're talking about designing the perfect strategy, what would that look like for you? Obviously, we could talk about high quality setups, perfect setups, trends, supply and demand zones, liquidity, inducement spans, timing, confirmations on lower time frames, trend lines, and I could go on all night. There are so many things we could add to the perfect strategies, but what would happen if you added everything and waited for all of them? Well, naturally, you'd have very few trading opportunities. Waiting all year for that one perfect signal, that flawless 10 out of 10 setup, well, that hardly ever happens, does it? So, what are you going to do? You'll have to make a compromise. You'll have a high win rate because it's a brilliant setup, but as a consequence, your trading frequency will be low. When I thought about this a few years ago, I realized that trading isn't just about maximizing your win rate. It's not just about that. That's too one dimensional a way of thinking, and there are compromises to be made. Then I moved on to risk reward, that is, the risk to reward ratio, and I tried to maximize that. I realized that yes, you can maximize your risk to reward ratio, but you'll end up leaving a lot of money on the table. What I mean is, you can go for a 1 to 10R ratio or even 1 to 20R, but most of the time, what actually works and what is globally the golden mean is between 1 to 3 and 1 to 5. After these, there's usually either a sharp correction or a bigger pullback, the market turns back a bit, and if you're using break even, you'll get taken out. If you're using a stop, that's what usually gets hit. The point is, you'll end up leaving money on the table because essentially you didn't take your profit at the right time, as you were waiting for a miracle, hoping it would go all the way to 1.20 or 1.30. So your partial system isn't optimized, and somehow your win rate will probably be lower as well. Or your trading frequency is too high because you're only looking for high risk reward trades. So there are always compromises. You always have to find a balance in trading. The analogy I came up with is that it's like those people at performances or events, jugglers, who throw balls in a circular pattern, sometimes juggling three, four, or even five small balls at once, and then keep them in the air. So their task is to keep all the balls spinning and not let any of them drop. New traders, on the other hand, like to juggle just one ball, and they think that the better trader is the one with the higher win rate. I'm sure I've seen trading adverts or trading copy claiming that someone is trading with a win rate of over 90%. Of course, they don't mention that they're at the game with stop losses the size of a house, and that's exactly how they manage to maintain that win rate. So that's just one side of it. It's a very easy narrative to fall into, even though it's not the reality. The win rate is not a performance indicator. It's not like in the gym where your bench press just means you're stronger. That's a performance indicator. As you get stronger, over days, weeks, and months, your bench press will improve accordingly. That way, you can track your progress. So, traders tend to think that the better a trader I am, the higher my win rate will be. And I understand where this idea comes from, because you'd assume that accuracy and reliability in your analysis are good indicators. But it's not an absolute measure of a good trader, because it's one dimensional for the reasons mentioned above. So we shouldn't focus on the win rate, nor should we focus on just one thing. In fact, we need to focus on balance, because every factor affects the others. If I optimize for win rates, I lose out on trading frequency, and I probably won't have the highest risk reward ratio either. So you have to look for a compromise. If your trading frequency is very high, your win rate will stay on the floor. If you opt for high risk management, then you'll have problems with capital growth because there will be big drawdowns on your account. So it becomes very volatile. So when I started thinking about how all these feedback loops work in this way and how everything affects everything else because they're all connected, I realized that I need to know what my controllable variables are and what I should be aiming for. That's how I started down this line of thinking. Spinning plates, and if I don't focus on the other plates, only on the one I've picked out, the others will fall, and that will ruin my profits when I return to the market. So I have to keep everything in a nice balance. What does this nice balance look like? I think a trader needs to know their own numbers. I'll tell you the acceptable ranges and what I aim for, but first let's talk about what these are, the things we want to control. So I mentioned the win rate. That is, what percentage of your trades on the market are winners? This is a variable we need to control, and there should be alert thresholds set as buffers on both sides. So at the top if it's too good, and at the bottom if it's too bad. The same goes for the risk to reward ratio. Now, this sounds a bit odd in Hungarian, this risk reward ratio. Set desired risk reward ratios and aim for these. We don't always have to go for big take profits, but we also shouldn't close parts of our positions too early or go for a 1-to-1 or 1-to-2 risk reward ratio, because there are balances. There's a perfect middle ground. We need to find out how we can achieve this. And as we start to control these things, everything else will follow from them in the future. So, another thing to control is trading frequency. How often do I want to trade on the market? This is important. So I don't want to make just one trade every quarter, meaning 4 trades a year. Yes, these could be brutally high quality setups. Let's say the win rate for these can be taken as 80% with confidence, which only occurs once a quarter. And in this quarter, in January, I found a trade by April and it was a loss. Why? Because my year started with a loss, right in that 20%. I wasted an entire quarter, and perhaps psychological issues also arose because of this. But why did I start doing this? I didn't start for this reason. I started because there was an 80% win rate. So just think about it. If someone says to you, I'll give you 50 grand, but you also have to invest, say, 10 grand, but there's an 80% chance it'll pay off. Of course you'd go for it. But if you only get one trade per quarter, that can really mess with your head. So the other thing that's very important is the capital curve, which will grow very slowly. By the end of the year, you might have 4 or 5 trades. Maybe you win 2 or 3, perhaps 4, and maybe 500% profit if you lower your numbers, because the previous one wasn't an 80% profit, but an 80% win rate on the trade. So let's say you make 5%, just to keep things realistic. This isn't the best, because another thing we need to assess is how quickly the capital grows. So capital growth is another factor. I repeat, we don't want any spikes and troughs. That's not good. Nor do we want slow, flat growth that's too shallow. What we want to achieve is a steady, fast-paced, predictable profit curve. Again, parabolic growth is also an option, but how can we achieve this? For that, you either need to scale up to trades with a higher risk reward ratio or choose lower quality setups to allow for high risk reward trades to appear more frequently. Obviously, this is extremely risky. So you either grow exponentially or you double up on winning trades and try to achieve exponential growth that way, thus modifying your risk profile, which again isn't good. This introduces another variable. Another variable is how you take profit, the take profit part. So I can take profit at subjective levels or at fixed levels, just as I do. I can always take it out partially, say at a 1 to 10 ratio, or I can limit it to 1 to 5, 1 to 3, or perhaps even lower. But I could also do it at a 1 to 1 ratio. What are we talking about here? I call those subjective levels, when you take your money out at, say, peaks or troughs, or perhaps when a level is broken. These are subjective. They change every day, and if you ask 10 people, then subjectively, everyone will always give a different answer as to which one they think is correct. Now, the fixed set locations are proportion to your risk in a fixed way. You always take it out at 5 or at 10, and so on and so forth. So, this is a variable that influences everything. We have a trading frequency, a win rate, a risk reward ratio. What about the duration of the trade? We don't want one day to scalp and the next day to swing trade. This level of randomness and sporadic approach is what leads to inconsistency, and this inconsistency isn't properly limited. By the way, I always say that trading framed by limited rules is profitable trading. What we need to recognize is that we can't trade, and this is another thing, one day with GBP JPY and the next day with USD CAD, then on the third day with gold, or even mixing them on the same day. And you can't trade during the London session one day, then the Asian session another day, then scalp one day and swing trade another. So you definitely need to eliminate this randomness from your trading. One day you're going for a 1 to 1 risk reward ratio, the next day you're planning a 1 to 100 risk reward ratio. This random ruins everything. And it might seem like you're doing the right thing because you're trying everything you've learned on the internet, every course you've completed, you're putting it all in one place and trying to make everything work. So you're trying everything, but this randomness will lead you astray. So we need to check all our controllable variables. And I always emphasize this controllable aspect because there's a part of the market that we can't control, namely when and in which direction it will go, or where it will go. Because if we knew that, obviously we'd all be billionaires. Everyone would be. Although no one really wants that. It wouldn't be good for the economy if everyone were a billionaire. So we need to examine our trading frequency. I like to make a maximum of 10 to 20 trades per week. For me, that works out as 3 to 4 to 5 per day. I only trade two currency pairs, so the selection of asset class is another factor. So if I want to achieve a high risk reward ratio at my own level, I have to be selective about this as well, which pairs I work with. If I want to achieve both a high trading frequency and a high win rate, then I have to trade a lot of different things because a high quality setup on EUR/USD, for example, only comes up once every 2 weeks or so. But if I trade EUR/USD, GBP/USD, and gold as well, then it could be as many as 10 a month, or even more, maybe 15. One moment, I'll just have a look at the chart. Right, I'm back. So if you make a compromise and take on too many, or pay attention to too few things, you'll end up scattered, confused, missing opportunities, and chaos will ensue. And you definitely don't want to be trading in the midst of that chaos. I usually say first that you need to learn to specialize in a single pair, which will be boring because there will be days when that particular pair simply doesn't move, or doesn't move as much, or doesn't move in the direction you'd planned. And at times like this, you'll be tempted to glance over at other pairs when, of course, they're moving. So you start thinking about what the ideal trading time frame is for you. What's the ideal time for you to enter a trade? What's the ideal risk, the capital that suits you? What's the ideal risk reward ratio that works for you? What's the ideal trading frequency that fits into your life? And then, when you have all of these, and I'll say it again, there can't be any randomness in them. So it has to be fixed. It has to be fixed every single time. And then you can tick off this part. Okay, tick. From then on, though, you have to stick to it. You need to know exactly what you're aiming for because you need these buffers and these warnings. And if it's random, obviously, these won't come. The other thing is trading psychology. Now, we can make loads of videos about this. Us, others, everywhere. Whether the stop loss is precise, where we put it, I agree. It's extremely important. But another thing is performance. How do you know if your problem is psychological or if it's a performance issue? And these might seem the same, but they're not. A psychological problem, for example, is when you deviate from your plan, from your strategy, from your written, defined plan. You make emotionally driven decisions in the moment when you shouldn't. You focus on the outcome, not the process. And generally, when I say outcome in everyday terms, it's just the dollars or the money or the zeros spinning before your eyes. So, all of this is psychology. Performance is a different matter. Performance is knowing that there will be winning and losing periods. It might be that a week will be a losing one, a losing week. I have to accept it. It might be that the month won't turn out as it should, a less successful month will be compared to another month. And I need to know this. I need to know if I'm trading too actively. I need to know if my win rate is too low. What am I doing to prevent this from happening? Okay, let's say the situation is really bad. I need to rein myself in. I need to focus on high quality setups. I need to know that it's all right. This week, I randomly made 10 trades and each one was valid and it's only CAD. So we need to get feedback about this. Of course, I can look at the history, so there you know what's going on. That's not really the problem, though. The bigger issue isn't usually with the data because the data's always available. It's right there in front of us. The problem tends to be that as people, we ignore it and don't acknowledge it. So we need to set up these buffers and we need to monitor our performance. That's why you need your numbers, so you know how to keep track of them. So, what does this mean? What's mine today? My trading duration is a maximum of 1 day. Most of the time, it's shorter. We're talking about much shorter periods, just hours. It's usually a maximum of 4 to 5 hours. I don't like holding positions overnight because, on the one hand, anything can happen, and on the other hand, the broker usually likes to play around during the night time. I'm talking about slippage, I'm talking about widening spreads, I'm talking about candles that by the time you wake up in the morning are no longer there, but still affected your position. So it's all a bit tricky. I enter trades during the London session 90% of the time, and the remaining 10% isn't really any different from my plan. And I try to also close trades at the London close. So at most, these are day trades lasting a single day. Usually, my trades only last a few hours. My trading duration is fixed. I don't switch between scalping 1 day and swing trading the next. The trading duration is fixed. The choice of asset class is also fixed. I only trade the EUR USD and GBP USD pairs. When I trade with these two, it's very but really, if I absolutely can't see any opportunities, then I'll have a look at AUD USD. I have to say, I only deviate from my two main currency pairs about 5% of the time. Right, and then I have a win rate, a sort of success ratio, which I deliberately keep between 45 and 65%. Right, so there are days when I want to execute correction trades, re entries, I want to execute. I want to take trades that are of slightly lower quality, because you'll have these too. There will be times when the market only offers you such opportunities. So these aren't bad setups, don't get me wrong. They're not reckless setups or anything like that. Call them what you will, but they're not perfect either. More like a 7 out of 10 or a 6 out of 10. If you're not in a losing streak at the moment, so you're not going through a rough patch, then you can go ahead and take these trades. But if you're making a 5% profit per week, then you can take on these kinds of trades. If your win rate is too low, say your average win rate over your last 20 trades is around 30% or even lower, or worse still, you're in a losing streak, then you know you need to slow down, leave these trades alone, and focus only on the high quality setups to bring your win rate back up. So, with these high quality setups, a high quality setup will be different for everyone. In my case, it looks like this. I have a checklist in my head with, say, 10 or 11 items, and the more of these I can tick off, the higher quality the setup is. However, if fewer things are happening in the market and I still want to enter, then that's a lower quality setup. So think of it like that. After this, a feedback. My risk to reward ratio is fixed, as I've already mentioned, between 1 to 5 and 1 to 10. Of course, these aren't numbers I just pulled out of thin air, they're based on analysing thousands of trades. This turned out to be the optimal approach for me, not maximising at the level of individual trades, but maximising at the portfolio level. I don't always focus on just the very next trade, as that would be foolish. Instead, I think globally. And now let's start to understand this. So we've assigned numbers to everything. Literally everything in trading is about this. And that's why at the weekend, I know whether I've stuck to my plan, it matches my expectations based on my numbers. And now, if we know the goals, we test them. This is very important, back testing. And let's say, all right, those are the options, the optimal targets I've set. And we back test and stress test them, and we ask, all right, what works better for me? Is my win rate a bit higher, or is it a bit lower? Is the risk reward ratio a bit lower, but is it better for me if I trade less? So after this, we start to understand the system and tailor it to our individual psychology, not to someone else's, not to the mentors, but to our own. So you start to get to know your temperament. And you realize that if you have 3 or 4 losses in a row, you end up in a downward spiral. This is something that needs to stop here, and it can't go any further. It has to stop at this point. So you can't have 3 or 4 losing trades in a row and then keep pushing it. You can't have 8, 9, 10 consecutive losses just because you believe that in the end you'll be right. The market won't work like that. And let me add here, I know of such accounts. I know of such people. I know of such students who get themselves into these 8, 9, 10 consecutive losses just so that they can be right in the end. However, I don't really know of anyone who has admitted this in advance. There are very few like that. So acceptance, admission, and then working on the problem. So my system and my psychology may differ based on different experiences. My self confidence and my market approach can also vary. Someone else might need something different. You too will have different experiences in the market. You too will have a different kind of self confidence in the market or towards certain setups. And you will have different market conclusions and data based on your back tests. So you need to know your numbers. Then you need to test your numbers in order to be able to manage your psychology. It's better to build a system around your psychology than to work solely on your psychology. Because the reality is, at least in my world, that if you have an emotion, you don't have to react to it. If you feel impatient and want to enter a trade, then it's not a psychological problem you have, but rather you don't know how to manage your impatience, which means you don't know what to do in the meantime. So you're impatient. If you found good things to do in the meantime, your impatience wouldn't be a problem. The issue, of course, is that people express their impatience by pressing the buy or sell button on the market, and they do it where they shouldn't. But this is what I'm talking about. If these trades made out of impatience happened in the right place, there wouldn't be any problem at all. Profitable trades, which means you don't know how to manage it. So instead of trying to handle every emotion, which is important, you should set up protocols, just like a property manager would. For example, if the upstairs neighbor floods the downstairs neighbor with water, you have to deal with it. The ceiling's about to collapse, and both sides are shouting at each other. Phone calls, bossy emails, stress, and so on. How can you handle the situation as quickly and safely as possible? And of course, make sure nothing gets damaged, or at least that any damage is shared equally. You don't just panic and stress out, trying to figure out in the moment what to do. No, you have a predetermined plan for what to do in such a situation. Despite the fear, despite the circumstances, I would know exactly what I need to do. This is exactly what we do in trading. We manage our emotions in a preset way. Many people say that when trading, you should take your emotions out of it and operate only according to your written, defined set of rules. Easy to say, isn't it? We have protocols for our emotions and our limits. We say, right, this much and this much. Loss, I've reached my limit for today, so I have to stop trading. That's my protocol. Or I have to stop trading for the week. That's another protocol of mine. Or from now on, I can only execute certain types of trades, nothing else. Even if the price moves without me, even if that less strong entry would have worked out, I put it aside. So this is how we manage our emotions. We shape the system so that it's optimized for us. If you can't handle a weekly loss, then really don't swing trade, right? If you can't tolerate a 20 to 30% drawdown on your portfolio, then again, don't swing trade, because over 3 to 4 to 5 years, positions can drop by that much. And yes, you might only recognize one per year. If you can't spot and react to fast moving prices, then don't scalp. So know yourself. You need to know who you are, what your psychology is like, so you can build a system around that. And this solves a lot of psychological problems if we add wisdom and confidence as well. Confidence is simply that the probability of something happening is higher. This confidence score comes from your back tests, your experience, your data. It comes from data. Right. It comes from data. If I've seen something happen 1,000 times, I'll be more confident. It's a linear process. Confidence is usually a common problem. We constantly and regularly receive emails about it, and people often get in touch saying, I'm not confident because of this or that. Mate, it's very simple. You haven't back tested enough, you haven't seen the situations, the setups, the processes enough times, so you're not confident enough and you don't trust your system yet. Right. Now you know this is your mistake, you know how to fix it, you can start working on it and watch these situations play out 1,000 times right in front of you. And suddenly we can start optimizing the outcomes of these processes, these emotions, to suit the psychology of our system. Dumb. All right. And I've mentioned this several times already, exactly how mine looks. And you've seen it in action as we've traded together loads of times. We've opened trades together. We've done back testing together. So this is a macro view, a bird's eye perspective of what the strategy should be like. You've already seen this. Now let's get into the details. What would your ideal harmony look like? Because these days, lack of knowledge isn't the root of the problem. Nowadays, there isn't a lack of knowledge. In fact, the problem is rather that there's too much knowledge. There's a wealth of knowledge available online, most of it for free. You don't need others. You don't need anyone to teach you. You don't need online courses. You need others to give you guidance, to show you exactly how to apply the knowledge. Because you all know what a trend line is. You'll know what a liquidity sweep or a liquidity zone is. You know everything, right? The problem isn't with the knowledge itself. And when you choose the person to guide you in acquiring knowledge, you need to be just as detailed and precise as when you select good trades, those certain 10 out of 10 setups. The problem with most advice, by the way, is how to put all this vast knowledge together into a system. Now, that's the mentor's job. Someone who can provide guidance, an advisor who shows you, who says, "This is exactly what I do. I can see that you're struggling with this problem. I understand, as I have faced it myself, and these things have happened to me as well. Well, this is what I did in the past to improve and to get to where I am today." That's exactly why we don't have a Discord group with thousands of members, or a Telegram group with thousands of members, or a paid signal service. We don't have anything like that. I don't want that. I want to work closely with people. That's why we opened the forum section on Telegram as well, so people can join in, we can discuss the trades, talk through what everyone is doing that day, what they're planning, and to show exactly what happens day by day and the price movements step by step. How do I trade? Day by day, how do I apply my concept and then give individual feedback over a longer period, showing how I managed that particular trade? What was my thought process behind it? What was it that led me to the point of pressing that buy or sell button, and not just for a week? In a week, you might see certain situations, but in a week, you won't be able to grasp how I guide you towards a particular way of thinking about your own system. We're talking about months here. Generally speaking, 6 months is usually enough time to achieve real growth with someone and to help people individually. Now, this is what I call a proper consultation, real mentoring, not those Discord groups and the like. But never mind. The reason I'm so passionate about this is that concepts alone are not enough. If you've completed 2 or 3 courses and you're still not profitable, it's because concepts on their own really aren't enough. You can learn everything for free on the internet, but no one becomes profitable just by watching videos. Or, yes, that certain 0 point something percent, but that takes years, terribly long years. I'm talking 5, 6, even 7 years of things like this. And unfortunately, these years aren't always measured just in time. Because if our person, our candidate, goes off track and learns a system that didn't even work when it was released, just had good marketing, then those years can be extended even further. You only become profitable when you know how to apply things correctly with a data driven, proven approach. What will this be? Well, according to my suggestions, you should limit yourself, for example, in what you watch, what you listen to, and so on. It's perfectly fine if you watch everything. I've never said that knowledge is a bad thing. I've watched everything as well. I also know, I almost said everything, but that's not true. So I know about 90% of the strategies you can currently find. I'm sure there's that 10% I've never even heard of in my life. There aren't many like that. You can look at trend lines, you can look at support and resistance levels, supply and demand zones, you can look at Elliott waves. I'm certainly not going to criticize or blame any system, whether it works or not, but we know what they're like. I'm not going to criticize these, but you have to realize that there are optimal things you should be looking at. There are probably better things and there are worse things. Besides that, it's also important how you combine these. If you just throw everything you've learnt at the market and hope it works, it won't work. I've tried it. Many of us have tried it. It doesn't work. It's too random. So you have to limit yourself and say to yourself, these are my confluences. This comes from the English word confluence, of course. Confluence is, in Hungarian, it sounds a bit funnier in Hungarian. So these are the things I know. I'm not going to trade them. These are my confluences. And among these confluences, you need to establish a hierarchy. All right, so from now on, this is the most important. All right, this one is less precise. But this is the one I won't compromise on. Now, hang on, this one, however, is absolutely necessary. And then there's this, which is just the icing on the cake. Now, these increase my confidence and turn the trades into top notch setups. You need to define all your concepts, then you need to define their order of accuracy, then you need to determine the steps. All right, you know everything. If you're missing two of these, what do you do? If you're missing three of them, what do you do? If there are five, but one is missing, and that one is absolutely non negotiable. So, what do you do then? So, you need to sort these out in advance. Because, as I mentioned, we don't start stressing, panicking, and acting on emotion when the situation's right in front of us. No, you need to sort these out in advance. Organisation, systematization. For a real trader, it's essential to do this professionally. This is a must, an absolute necessity, something exclusive. This is what you have to do. So, while I'm recommending this, in my opinion, some of the most important things include, for example, the daily cycle. For me, this is indispensable. You need to know how the sun moves. Ritz, this is your GPS, this is your map. The exchange rate doesn't go from A to B directly, it only gets there via certain routes. Sometimes Asia starts from point A and then moves higher. On other days, Asia starts from point A. A smaller breakout goes higher, then lower, and then New York decides to turn the whole thing around. So there are routes to the same outcome. It doesn't just go from A to B, it follows different variations. These variations are based on a daily cycle. Now, the daily cycle is centered around market structure or around market price action. Very, 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 and now I really mean it in capital letters. You have to be careful. Liquidity zones, inducement zones, as well as, well, the time of day, where exactly we are at the moment. Because it's no use having a liquidity point if it's at a time of day when you shouldn't be paying attention, right? So this is how we can define our daily cycles. This way, we can now create derivatives. We know that it's very important to understand the liquidity cycle, how inducements work and their types, as well as time-based manipulation during the most significant periods of the day. And we need to know all of these. When do they happen? When are manipulations most likely to occur? When do these take place? When should we prepare for them? You really need to be sitting in front of your computer well in advance when these are still in the preparation phase. I'm deliberately not going into the strategic elements right now. You know them very well yourself. Volatility enters at that point, and during those periods, as manipulations of these levels lead to significant movements. These will become much more important than anything else. And for these periods, you need to establish protocols, right? So, periods, levels, manipulations. Why? So that they lead to certain significant movements. So, what happens with the pro trend? Pro trend. So, how can I put this differently than when we simply call it a plain trend? What happens? The trend itself is present in the situation, but the liquidity shows the opposite. Which one will you follow there and then, in that very moment? You can't just make it up, because then it becomes an emotional matter. There must be a pre established strategy and rules for this, so that psychology does not influence or alter your decision there and then in any way. When you first realize that the inducement is saying one thing, and supply and demand, or demand and supply, is saying something else, and on a lower time frame you see something completely different, well, what do you do then? What's your protocol? What do you do? Right, this is when you need your checklist. That particular checklist, which you can write down on paper or you can put it up on TradingView. Of course, we have that little TradingView indicator for this, which is always there, and then you just follow your little checklist. You can do this as well. If you've got that checklist down perfectly in your head, say you could recite it even if woken up from a dream, then of course you can put the paper aside or get rid of it. But you need to have this protocol, and those checklists shouldn't be random or haphazard. There needs to be a hierarchy in it, so it's clear what follows what. Because actually, losses, many people's losses, don't come from bad trades. Believe me, I've seen enough trades, thousands of them over my lifetime. And I'm not just talking about my own, but from lots and lots of people, because they're always sending them in. Okay, thousands of alerts. Because I always ask for screenshots, whether the trade's good or bad, I'm not bothered. A lot of people do the right thing, actually. In the wrong way, at the wrong time, in the wrong place. But the right thing nonetheless. It would be really important to sort this out, and most people's losses would simply disappear. So, not by learning new concepts, but simply by using the existing ones better. Protocol, managed systems, hierarchies, these are the most important things. If I could give you any advice for this mentoring, I'd say focus on liquidity, focus on inducement zones, and focus on timing. This is the fuel of the market. At present, or in the last 3 years. I don't know how to put it, but I feel like it was the same today as well. You could see it. This is what moves the market. And if you find them, you'll see the market and price movements from a completely different perspective from now on. So I hope I've helped, and I'm looking forward to your screenshots tomorrow. Whether the trade's bad or good, just send it. All right, cheers.